Attention people who still care. On today's show, the FDIC cracks down on crypto platform Unbanked for making misleading statements about deposit insurance. Strangely enough, Unbanked announced 2 months ago that they would be shutting down for good. Which begs the question, how tough must the FDIC feel now for standing up to a company that's going out of business? One word: courageous. You are listening to the Crowd Effect Podcast. I am your host, Paul Lovejoy, licensed investment advisor at Stakeholder Capital. On August 4th, the FDIC sent out a press release and a cease and desist letter to Unbanked's co-founders. In the letter, the Federal Deposit Insurance Corporation, or FDIC, has ordered Unbanked, Inc., a non-bank company that offers crypto-related products and services, to cease and desist from making false and misleading statements about FDIC deposit insurance. The FDIC has asserted that Unbanked had represented on its website, in promotional materials, and on social media platforms that its crypto-related products and services were FDIC insured. An FDIC-insured account is an account at a bank where deposits are federally protected against bank failure or theft. The FDIC claims that Unbanked's statements were misleading because they implied that FDIC insurance was available for cryptocurrency and that it would protect against cryptocurrency-related losses. Cryptocurrency and losses due to cryptocurrency investments are obviously not covered by FDIC insurance. The FDIC's order requires Unbanked to immediately correct its false and misleading statements and to take steps to prevent future violations of the law. The order also prohibits Unbanked from using the word FDIC in its name, advertisements, or other documents in a way that could mislead consumers about its products and services. Following the FDIC's order will be very simple for Unbanked, being that they have deleted their social media accounts. On their website, there is a banner at the very top saying Unbanked will be winding down, with a link to a statement from Unbanked's co-founders Ian Kane and Daniel Gouldman. The statement, which was issued over 2 months ago on May 26th, says, and I quote, "To state it bluntly, U.S. regulators are actively trying to stop companies, banks and fintechs, from supporting crypto assets, even when the companies are trying to do it correctly and by the book. Their efforts are working and ultimately limited Unbanked's ability to raise capital and run a self-sustaining business," unquote. The statement mentions how awesome of a mission that Unbanked had and proved naysayers wrong by integrating 25 companies around the world into their platform. However, they also go on to say that funding was supposed to come through, it never did, and now cannot continue with its operations. Wouldn't that be proving the naysayers correct? Well, at any rate, as the Unbanked statement points out that they never received institutional funding and only received funding by bootstrapping and through equity crowdfunding campaigns. All right, there is a lot to unpack here. First off, the obvious. What is the FDIC trying to accomplish by beating a dead horse? The only explanation that makes sense to me is that they are trying to send a message to other crypto-related financial platforms to leave the FDIC's name out of their platforms. However, U.S. regulators have been making it very clear that the United States government does not trust the crypto industry since the collapse of FTX back in November of last year. There have been so many online crypto platforms that have failed since this collapse, too many to count, which makes me wonder, who exactly are they trying to send a message to? There are hardly any crypto platforms left, and the ones that have been talking about moving overseas and setting up operations outside of U.S. regulations. Secondly, with the failure of unbanked and the crypto collapse, who got hurt? The little guy. When crypto collapsed at the end of last year, it was the small investor that lost out the most. Unbanked got a large portion of their funding through equity crowdfunding campaigns, which I'm a huge fan of. But the people who invested in unbanked will lose their entire investment. Again, the small investor loses. Lastly, the entire crypto industry seems to be dying, losing massive momentum. Regular people do not want to get burned again and lose more money in crypto. And US regulators are taking a very tough stance with the crypto industry, making it very unfavorable for crypto-based companies to continue its operations here. However, it doesn't mean that the decentralized finance movement has to die as well. The crypto movement was well intended, but from my point of view, skipped a very big step, diluting the concentration of wealth of fiat or traditional money from big banks. If cryptocurrency wants to replace fiat currency, there has to be a place where you can exchange crypto for fiat. And if it looks like crypto will actually replace fiat, then what would stop a big bank from exchanging all their fiat wealth into crypto wealth? How does that decentralize money? Today, just 4 banks control half of all the banking assets in the United States. These banks are number 1, Chase, number 2, Bank of America, number 3, Wells Fargo, and number 4, Citigroup. Now, these 4 banks happen to be some of the most penalized corporations in the United States. So there is the Violation Tracker Project, which has been tracking all corporate fines and settlements since the year 2000, has ranked every single corporation that's operating in the United States according to how penalized they were. At the very top of the list, Bank of America, they have been penalized more than any other corporation out there. $87 billion worth of penalties. Number 2, Chase. Number 3 is British Petroleum, but number 4, we're back in there with Wells Fargo. And number 5 is Citigroup. Now, there is a little bit of changing between Citigroup and Wells Fargo, and that's because more penalties are coming all the time. Bank of America just got penalized $250 million a few weeks ago. Chase just settled a big Epstein lawsuit last month. It just keeps on happening. These fines and settlements are just nonstop. So let me put it in perspective at how unethical these 4 banks are. So if you combine the penalties of just these 4 banks, which control half of all the banking assets, they have been penalized more than the pharmaceutical industry, more than the oil and gas industry, more than the chemical industry combined. So this is such a unethical and corrupt industry, the financial service industry, that just 4 banks are getting penalized more than the second and third most penalized industries. This is obviously we have a broken financial system, and the crypto movement, it was trying to fix that. However, as I said, it skipped a step. So what can be done? How can we dilute the wealth of these 4 big banks and redistribute that wealth to regular people without using regulations or laws or even government at all? Well, there is a way. and it's through crowd investing. Now, I mentioned equity crowdfunding earlier, but there is another type of crowd investing called crowd lending. This is when a large group of people pool small amounts of money to fund a loan. Now, there's a couple of big advantages of this. First off, instead of a bank issuing the loan and reaping the profits from that loan, well, now regular people can do that. In 2015, Regulation A Plus was passed, and in 2016, Regulation Crowdfunding was passed. This allowed the general public access to private lending through crowdfunding. And so now regular people with as little as $10 can pool their money into fund different loans. Another advantage is that regular people, we now can decide who gets funding and who doesn't. Big banks, they love to finance big business ventures and large corporations. And they hate funding small businesses. But with crowd lending, any of us now can fund a loan to a small business, and we can mitigate our risk through the crowdfunding process just by putting up a small amount of money. So if you have $1,000 to invest, you can be diversified into 100 different loans. That's bank level diversification right there. On top of that, when a commercial bank issues a loan, it creates money. It's inflationary. A big part of the crypto movement is that it's deflationary, only having a certain amount of crypto, and that's it. Well, both of these approaches are horrible for our overall economic health. On the one hand, the commercial banks, they're creating money. See, they're allowed to issue loans based on the deposits of their account holders, but they don't actually use their account holders' money, right? Imagine how you would feel if all of a sudden you had no money in your savings account because the bank decided to use it to loan it to somebody. Well, they're legally allowed to create money this way. And so it's inflationary. They're creating more money, and people are putting it into their bank accounts when they get the loan, which allows the bank to create even more money. So it's this process of just constantly creating money. On the downside of the crypto, of the deflationary, well, it creates a net zero outcome. There's only a limited amount of money, so it doesn't allow for economic growth. It just has a fixed pie with so many slices, and it's going to create a situation where people are fighting over one pie. Well, we do need to have some money creation for the pie to get bigger, for regular people to increase their own wealth. And so we need to strike a balance. And that's where the beauty of crowd lending comes in. There is no money creation that happens to it. It's a way to stem inflation by issuing these private loans, where you actually have to put up your money. There's no money creation that's going on. So it is. It's able to strike that balance of both growing the pie, allowing some money to grow, but at the same time stemming inflation through private lending. Now, all of this is fine, but what's really needed here also is for just regular people to stop using the big banks and just put your money into a credit union. Now, banks, the reason why I believe that they're so unethical and so corrupt is because of this pressure that they feel to constantly to increase their profits. It's well known that corporate bottom line plays a huge role, if not the primary role, in decision making in these corporations. And when you have this pressure to increase your profits, with these quarterly statements that are released every 3 months, And when the quarterly statements are good, oh, you're getting bonuses, high fives. But when they're bad, executives can be fired by the shareholders they for breaching fiduciary duty. That's a legal right that they have. So it creates this pressure, and it's inevitable that unethical behavior will happen. Well, then what happens? Then they get busted by the regulators and they pay a fine, of course, and then new regulations happens which make it even more expensive to operate their business. So now they have to get creative in finding ways to increase profits. So what happens? Well, you can see what's happening now. All these horrible fees, double dipping on fees, strange overdraft fees, going into see a teller fee, the ATM fees. They're just getting creative with these fees, which is just abusing its customers. With a credit union, there isn't that abuse because they're nonprofit and they offer the same exact services, except for a lot cheaper, because when they have revenue above their expenses, they pump it right back into the credit union, offering wonderful services for free, often, financial education, lower interest rates on loans, higher interest rates on savings accounts. It's a whole host of wonderful things. So crowd lending, credit unions, this is the way we can decentralize finance, not through the crypto. That's next step. First, we got to do this, then we got to do crypto. My name is Paul Lovejoy. I am a crowd investor, and I see you are one too. If you'd like to discover the 3 secret steps to fix our broken financial system democratically without confrontation or divisive political action, go to stakeholderenterprise.com.